Welcome to Driven, the Unscripted Success podcast, with your hosts, Mike Menino and Nariman Hamden, bringing you insights and stories on achieving personal, professional, and financial success.
Hi, everybody. It's Michael Menino, and welcome to Driven, Unscripted Success podcast. Today on the podcast, we're interviewing professionals who share their experience with you, the audience, on how they got to where they're at today. And zooming from Florida, we had Jessica Casucci. Is that correct?
Casucci, yes.
Casucci, yeah. I kind of, not bad the first time seeing I'm Italian. Jessica's with Archangel Solutions. She's our new friend for real estate. She's a tax professional that shows people how to navigate. Is that the word I'm looking for? Navigate the complexities of taxes.
Not just navigate. I just try to take the complexity out of it because people get intimidated. They see the code, it's pages. If anybody looks at a book anymore, I don't know. And everybody's scared and they're worried they're going to get Al Caponed all the time. That's what I like to joke about. Nobody's getting Al Capone. And actually 90% of the tax code is written for our benefit, but nobody knows how to utilize that. So I like to take all these complicated ideas and make them simple and actionable for people. So I give people clarity and I give them a roadmap to move forward.
That is probably the greatest words I've heard of any tax professional I've ever listened to. Because some people want to make it sound complex, so it's more difficult, and then they need you. But if you're trying to make it simple for everybody, that's just perfect. Bravo.
Well, I just think if I make it complicated, it makes it harder for you to work with me.
You'd be surprised how some philosophies are with tax professionals. That's why you are our new tax professional. I've been in this business for 30 years in building, construction, multifamily, everything. And I haven't found, I've listened to some of your stuff, and nobody makes it as easy as you that I've ever seen.
Well, I thank you for that. I just figure that, I want to be able to explain things to my family. And I came from a very blue collar family and a lot of my friends. And if I can't explain it to them, then I'm not worth my salt. So
speaking of that, great setup. Tell us about, how you got to where you're at today.
Sure. So I don't know if it's a funny story, but it's an immigrant kid story, except skipping a few generations. So I was born in the Bronx, and my parents had me very, very young. So my great-grandparents and grandparents stepped in to help raise me, but for all intents and purposes, raise me. So, there's no such thing as boredom. There's no such thing as, getting what I want. There was no special meals. My great-grandmother would say, this is not a diner. You eat what you eat or you don't eat at all. But on the whole,
Typical Italian household,
7 of us at the table every night, loud, boisterous, loved each other. I grew up in a neighborhood where a lot of the families had lived there 50, 60 years. And so it was like I had 8 grandmothers. And if you did something bad down the block, it funneled its way back, that's for sure. But neither one of my parents even graduated high school. They both dropped out in 9th grade. And I was very lucky because I was blessed with this big brain. And I knew that I wanted to see the world. I knew I wanted a different life than a lot of people that I grew up with. I loved them very much, but I just had this drive to see the world from a very young age. And I knew that the only way I could do that was to go to school. Back then you had these ads for, join the army, see the world. But in the culture and the time that I grew up with, women didn't do that. So I had to figure out another way. And so I got a scholarship to college. I just checked boxes where I wanted to go. I followed the money, went to BU and started off as a math major because math came very easy to me. And then I realized I had to get a job and I didn't want to be poor because then all the sacrifices they made for me wasn't going to do anything. Like I was the great white hope to help everybody, right? So I said, okay, I switched into finance at that point. So it wasn't a very altruistic reason, but it was a reason I wanted to help my family and make sure that they never had to struggle. And so I went into finance and then someone inspired me to put this big mouth to good use, and I ended up in law school. And I actually was going to be a prosecutor, but I wouldn't have been able to pay my loans back or do anything. And I also think my temperament at the time wouldn't have gone over very well. And EY recruited me right in law school. They saw this kid who had a finance undergrad and a JD and a great work ethic. I worked through college, law school, just constantly, and said, okay, you can survive here. And I was in their first class in their financial services practice way back when, and ended up working with them for 18 years. So I became partner, working all around the country and the world in a very niche area of investment partnerships. So private equity, hedge fund, and real estate for my whole career. And then took some time off for life, moved to Italy for a little while, came back because of family reasons and life reasons, went back to work, and then remembered that I didn't want a boss anymore for a lot of reasons. And then I formed my own company this year, and pretty excited about that.
We are too. That's like I told you, I love the name. I'm a little sad because I wish I could have took it. In taxes, what is one of the biggest misconceptions people have about taxes and wealth?
Well, I joke. I said it earlier. People think they're going to go to jail if they make a mistake. I hear that all the time. I know it seems silly, but maybe not someone as sophisticated as you, but I hear that from everyone I speak to. They're just scared if I make a mistake or I forget a form that they're going to go to jail and lose everything. I'm like, people make mistakes. That's okay. And there are easy ways to correct that. You're not going to lose your house. You're not going to lose your family, but you have to address it timely. And there's provisions made to help you when you make mistakes. The only time you're going to get Al Capone is if you say, like, I'm a sovereign citizen and taxes don't apply to me, yada, 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 all that craziness.
Right. They don't like that. They don't like that conversation.
Yeah,
they don't like that verbiage.
That doesn't work, right? So, and then, from a business perspective, I think where I see people, it's not make mistakes. It's misconceptions. It's just a lot of people don't think about using taxes to their advantage. And I like to say, use it to your advantage. It's a necessary evil, but if you use the provisions correctly, they can help you get to your goals. You just have to have somebody on your team that really is on your team and understands your goals, your why, and where you want to get to, because they can't really help you after the fact. I joke, I'm an attorney, not a magician. I can't go back in time and undo things you've done, but we can be proactive and go forward and use the code to help you grow your business, grow your investments, help your community. And people just think it's just a pain exercise and that's it. So I try and show them a different way.
What I've learned is the best way to describe what you're saying, is find the right partners. If you're, we build teams, and if you have the right partners involved, like a tax professional, and then someone, an accountant, and you take the advice. Here's another one. Take the advice that the professionals are giving you, then you'll do well. That's what I've noticed.
You'll do well. And also understand there's a difference between a tax strategist and someone who files your return.
Could you explain that? Explain that, because I get it, but I want the audience to understand.
It could be the same person, but most likely it's not. And here's why. So a tax strategist, we're forward thinking. Again, if you're talking to the financial planners, you're talking to the lawyers, you're talking to members of the family, understanding what their goals are, their dreams are, and then you're working with all the members on the team to facilitate that going forward. And thinking, short-term, long-term, medium-term, you're thinking about the types of income, marrying income with buckets, looking for deductions. I had a phone call yesterday with a client and I'm like, get me on the phone with your Goldman guy, because let's look at different passive investments that are going to kick up this type of income, because we know you're going to have a property that's going to kick off certain deductions. We want to wipe that out. So you're thinking about it from a really holistic perspective. A tax preparer might just be someone who you give them information come January, February, March, they get stuff on the form, and that's very hard work. Don't get me wrong. I've done that. I've trained my teams to do that, but it's a different skill set. And, they're generally looking over the rear view mirror saying, okay, what'd you do last year?
Here's what you did.
Get it on the right place, right? And that's it. And again, some people can be both, but I generally don't see that to be the case. And even if you're working with a big firm, right, your strategist might be your partner working on your account, but the partner has a team of preparers underneath that are making sure the filings are getting done and on the forms. And it's important for a strategist to also know that as well, because if you've never done that, you're a doctor who's never actually operated on a patient. So we need to see both ends, but I like to focus on the strategy myself.
I think I just got it right now. The tax preparers are worried about the past. You worry about the future. I like what you were saying there. That's a pretty nice way of putting it. And that's what we like to do is we like to show people, what the future holds. Here's a question for you. Why is real estate one of the most powerful tools for tax efficiency?
Oh, wow.
Ooh.
I keep this simple. So
you said that at the beginning.
No, I am. Okay. So dirt, they're not making any more of it. So on the whole, real estate tends to go up. So the value is going up. But there are provisions in the code that actually incentivize those people to go out and buy real estate. It's good for the country. It's good for the economy when people are building, when people are rehabilitating houses. Why? Because that keeps the populace happy, whether it's offices or residents, and everybody's chugging along, working, feeding the economy, and going. So the code incentivizes the industry, and it has provisions that allow you to get current cash and current deductions at the same time on the same property. You don't have that in a hedge fund scenario. You don't have that in manufacturing as much, or a typical stock. You don't, because you're either
you don't
up
get that.
or you're down. You don't find a way to get your cash and get a loss.
When you lose in stocks, the government doesn't care, but when you win in stocks, they care the most.
They care the most, exactly. And then and honestly, yes, you can. There are some deferral provisions in stocks, but there's a lot of things. If you try and defer, you actually get tagged with other rules that force you to actually recognize those losses if you try and defer in different ways. Whereas the code has provisions which say, hey, you might have a loss on this property, but if you flip it for something else and you follow the steps we lay out for you, you don't have to recognize anything. Or if you have a gain, which is why people really do it, you don't have to pick up that taxable income. We're going to let you defer it. We're going to let you defer it as long as possible. And there's a joke, defer until you die.
Yeah, that's what I was going to say that.
Defer until you die. Well, then
explain that process. That process.
Okay. So let's say I have a house. We're going to keep it simple. And it's an investment property and I got a great offer on it, but there's $100,000 in gain on there. Well, the code has a provision called 1031, which I'm not going to go into all the steps. It says, okay, well, if in a certain amount of time, if you identify a similar property that is worth the same amount or higher, you can basically sell that first property. And instead of recognizing that $100,000 in gain, you can tag it to the new property. So it follows your activity. And as long as you don't break that chain and you follow those steps.
And you need a qualified intermediary, right?
Yeah.
You need a person to do it for you.
There's a lot of steps. There's companies that specialize in all of that. Even tax professionals. Look, a woman I used to work with has as much experience as me. She used a 1031 company for an investment property. She's like, no, this is what they do all day. It takes the headache away from me. I'm all about using the right specialist for the right activity. But where the defer till you die comes in, if you keep doing this with successive property, so then the gain goes from $100,000 built into $500,000 built into who knows what later on,
A
a
million,
million.
5 million.
And then you're older, you meet your maker in your sleep, nice and gently, and you did what you were supposed to do and you left it to a loved one or charity somehow. Well, that gain that was in there, and sorry, I'm using my hands if anybody's
You're
just
Italian. We're
because I'm Italian, but I'm
That's what we
gesturing
do.
gap, right? Well, then that built-in gain goes away. There's no more built-in gain at that point. They get something called a step up in basis. And so their basis becomes the value of that property on the day you left it to them. So
No matter what the tax liability is, I think there's a limit, 250 million, 25 million, or some million number that it is. But let's just say you have $1 million in taxes you're supposed to pay that you were supposed to pay for 20 years. And the day you pass and you we've got a will and testament for our kids. And when they get it, the tax is free and clear at that point. They start paying taxes from that day, correct?
Correct. And now I'm not an estate attorney. So I would say there's estate tax issues and things like that you have to think about depending on the size of your estate. We're not going to go into that again.
Right. Too deep.
Well, right person for the right procedure, right? I always say just like doctors, it's easier to understand. A lot of people think lawyers, it's one size fits all. I'm like, I'm a neurosurgeon. You might need an orthopedist. People get it when I explain those things. Like I still have family who call me about like a slip and fall or this and that. I'm like, not my thing.
I would love to see you do at least one litigation. I think you'd be amazing at litigation.
Thank you. I appreciate that. It probably would have been I don't know, more aligned use of some of my skills. But at the time, you see, a lot of people don't realize if you owe a lot of money between college and law school, even with great grades and grants. And I'm talking 25 years ago, I owed $150,000 between college and law school at 24. And what a lot. And a lot of times people go into litigation or clerk with judges. They have the ability to take unpaid internships in those summers. I did not have that ability. I was pretty much on my own since my grandparents passed away. And so, I just worked. I worked and I ended up getting jobs in the corporate arena. My first job in law school that was related to the law was Philip Morris, and then it was Ernst & Young, and I just had to go down the corporate path because I would have starved to death, to be honest. So.
Yeah, well, I know what it's like to be hungry. What is the top 3 advantages to multifamily investing versus anything else you've seen?
Well, one, the bonus depreciation on multifamily investing is incredible.
We'll get to that in a minute.
We'll get to that. So the amount of tax losses that are just paper losses are just a wonderful benefit in the code. I think that's great. And then following on that, cost eggs that go with that. I think multifamily, depending on how you're investing. So if you're going through a syndication, it's great because once you vet the sponsor of the deal, they've done a good job, and we can talk about sponsor vetting if you want later on. You kind of set it and forget it. You cut a check, and then you get cash every month or every quarter from the rent rolls, while your K1, which is, for those of you out there, a K1, the best way to explain it, it's like a W-2, but for partners in a partnership, but no taxes taken out. So it provides all that information. So syndications, multifamily, that just means large partnerships, y'all get a K1. Well, there's no tax coming out, so you don't have any leakage there and spend on your ROI. You're getting cash every month, and then you get this K1 that has a big fat loss on it that you can use to offset other types of income, depending on what you're doing. So that's, again, great. When you compare that to like stocks, if you're getting cash, that's income, period. End of story.
Right. So, there's no advantages tax wise. You're just going to pay. And if not mistaken, if you do it in the first year, you're paying the most taxes. If you defer, not defer it, but sell it a couple of years later, you're
Oh
going to
yeah.
pay less taxes, but you're still going
Yeah.
to pay great taxes.
You're still gonna pay great taxes and, if you're not holding long-term capital gains, all of that. Obviously, we just talked about the defer till you die situation. You can't do that
1031.
with stocks. You can't,
No.
you can't do that if, you're opening up a manufacturing company. So 1031 depreciation and cost eggs are great. From a kind of why I like multifamily real estate, because if you're doing a good job, you're actually impacting people's lives.
Yeah.
It's concrete. And so
Mhm.
I like to have impact where I invest. And so depending on who you're working with, that's part of what I vet people for. What are you doing in the communities? Are you a slumlord? Then that's not going to fly. But you're making people's lives better? I love that. Let's go. So
You're giving them a nice, safe place, clean place to live. Nice, safe, and clean place to live.
and think about that. I don't know, psychology. What was it? Maslow's hierarchy of needs?
Mhm.
Safety, housing.
Right.
It's the number
Right.
one need for everyone after oxygen and water, right? So,
Yep.
think about how many lives you can touch with that one investment. So those are three things I love about real estate right there.
I love them too, and I love showing people. So
Mhm.
that's the real reason I got you on here, just because you're the tax professional and you can explain a lot better than I can. So
Thank you.
in a syndication, you talked on this a little bit. Let's go a little bit further. In a syndication, what you're looking for is the GP and the LP partners. The LP partners are the one that brings the money to the deal,
Mhm.
and the GPs run it. And you had made mention that you have some strategies on how to find great GPs. Can you elaborate a little bit on that?
Sure. So when I'm looking at GPs, I'm looking at, first of all, track record.
Mhm.
How long have they been operating? How many deals have they done? How many deals have they done of this size? Do they have co-sponsors? So then I
Mhm.
check out the co-sponsors. What are
That's a
some
good
of
one.
their communities like? If their communities are accessible to you, go walk them.
Mhm.
See what they look like. See how people are actually living in them.
Mhm.
If honestly, it might not be great before they go in. So you might see this multifamily housing and it needs some work. It's a little bit shabby, but that's when these guys come in and they fix them up and they improve people's lives. So what's their intention with the deal? Are they looking to make capital improvements to grow the rent rolls, increase rent, improve lives? What are their intentions for the deal? If you can, talk to people who have invested with them previously. Some
Mhm.
people will be okay doing background checks and criminal checks, but honestly, the most important thing is looking at their history. Who have they worked with previously? What have they done? Sample deals, all of that. You just really need to do your diligence. And then you have to really look at the exit strategy and how it all lines up with what you want to do. Because another great example is if you're thinking of investing in one of these deals, well, it might be at 7 to 10 year horizon. Are you comfortable with your principal being there for that amount of time or not? And you better make sure you're understanding how you're getting your money in and out. And sponsors, if they're leading with tax savings, that's not necessarily your sponsor. I want to hear about the deal itself. The deal should drive the tax savings, not the other way around. I don't want to hear sponsors coming to me, shopping me the tax benefits. I want to shop me the ROI on the deal.
There you go.
Period.
Return on investment.
Yeah, return on investment. Sorry.
Yeah,
If I say anything in shorthand that I need to.
I'm just going to run the acronyms. You're going to hear IRR, internal rate of return. So that just basically means your return on the property.
Mhm.
And yeah, that's great advice. There's a lot of people that I love explaining this to people. I love showing, what I love doing is bringing institutional grade assets to the average person. When you're when you were doing your law, it was the big companies that were getting the great deals. And
Oh,
that's what
yeah.
I found. And what I found is that's not the way it should be. I think the great deals should be with the average person.
Right.
You know
And
what I
that,
mean?
that was something actually, growing up the way I grew up and having a lot of friends and family and seeing all these creative ways that people were reducing or eliminating taxes, I was like, well, no one else has a chance if they don't know this stuff. They just think, go to work, get a good job, go to school,
Pay taxes.
so I reversed that, but you know what I mean? Get a job, work till you're dead, and then hope for the best. Sorry, I need a tissue 1 second. And you're not going to win. You're not going to grow wealth like that. But people who can afford these advisors like me can. So I just said, how do I democratize that a little bit? And that's also another reason why I formed my company, because I saw a lot of women who were relatively successful, my age, and they didn't have the time or they didn't trust anybody to help them vet these things or to teach them these things. They were tired of like crypto bros screaming at them on the phone and saying, you're a loser if you don't do this and do that. And I just said, why can't I go out and teach people how to do this on their own? So that's part of the reason I create some things that I create.
My mom got a divorce when she was young, and I like helping out. We seem to be falling into, divorcees that don't know what to do with their money. And once they separate from their husband, they have no clue how to invest. And we show them a bunch of different strategies, and it always falls to multifamily seems the best because, like you said it, forget it.
You said it, forget it. Well, you're talking about divorcees that have money. How about it? I use myself as an example all the time. I was the primary breadwinner when I got divorced because it was such a difficult divorce. I basically gave him everything. And
I'm sorry.
And alimony, that's a different story. But I wanted out so badly. I just said, just take it.
Here you go.
Take it. It was my freedom payment. That's what I called it.
It was my freedom payment.
It was my freedom payment. So I just said, okay, well, how do you, I've had to rebuild. So how do I help people rebuild also? Whether it's, I was talking to a woman the other night, whether it's divorce or a death, once you get through the shell shock of, the life impact, you're like, okay, how do I facilitate my life after this? Well, if I can help you financially and set it and forget it while you're dealing with the rest of the wreckage, then I've done
that help. That is true help. That is true help. So getting to the most important part, the reason I had you on this podcast, let's talk about cost segregation and accelerated depreciation. So accelerated depreciation 6 months ago, less than 6 months ago, was at 40%. Could you explain cost segregation and depreciation and where it was and where it is now? How's that?
So I'll take it back. I'll explain what cost segregation does first.
Okay.
And then give you some numbers. So cost segregation or cost seg study, which you'll hear people use those terms. All it is when you buy a property, it could be a single family home. It could be multifamily. It could be, just pure commercial, anything. Well, there's a value to the whole project, but there are components within that. So think about an apartment building. There's the land, there's the building itself, the structure, meaning the walls, the foundation, but then there's all the stuff that goes with it. So
the toilets, the countertops, the cabinets, I know all that. I'm the builder part. The cabinets, the countertop, the appliances, the flooring, all that kind of stuff.
This is how I explain that to people, because all of this stuff has a different life under the tax code. I mean, a usable life. And there are rules that say, okay, you can depreciate that, which just means you're deducting the quote reduction in the assumed value. That's what depreciation is. It's not a cash expenditure. It's like, think about wear and tear. Your car over time, the value goes down, everything else. So, but different items have different lives under the code. So stuff like desks, anything that you can move in and out, it's personal property, it's got a shorter life. Then things like lighting fixtures, things that are attached to walls, have a longer useful life. Why? Because you're using them less, you're touching them less. They're built to last. Then there are things like swimming pools and sidewalks that are outside their improvements, but they still have a shorter life than a building. The building itself, actually, excuse me, the land has an indefinite life because
that's the one thing that's
hopefully, right? The government
it's not going anywhere.
It's not going anywhere. The value is going to only go up because nobody's making any more dirt. The only time you ever get a reduction, some sort, and I'm simplifying this, is if there's like a natural disaster. Think about Superfunds, chemical spills. Those are very specific provisions under the code that you hope to never have to use.
Right.
So in general, land, you're not doing anything with that. Then the building is the longest life asset, and then everything else is shorter. So that makes sense. So you do a cost segregation study because without one, the rule of thumb is kind of like 80-20 land, building, and then you have a kind of a slow life, and then you're depreciating over, 29 years.
27 years is the max, correct?
The max, right? And and that's a long time. But if you do a cost segregation study, someone comes in, a group of like a firm, whether there's generally engineers, accountants, a whole team of people, they come in, they analyze everything down to the studs. The light, the carpets, the this, the that, the dog park you put outside, all of that, they analyze that, they put it into those separate buckets, and then you get to accelerate those deductions. So a rule of thumb, when you do a cost seg study, you generally are going to get about 20% more of bonus depreciation in a given year, at least 20% more. So
at least 20% in every given year, the first
meaning 20% in general of the value is going to get immediately allocated to shorter live property. So you're getting the benefit forever, but the bonus you get in year one because you still are accelerating all these other items. So let's again go back to prior to July 4th of this year. Okay. So there was a provision in the code that said what's bonus depreciation, and bonus is just a nice way of saying extra. And there were rules from several years ago which said, okay, you get extra depreciation and you can accelerate it on certain types of property. Well, it started off at 100%, meaning you get to deduct the full value in the first year you bought it and put it in service, because putting something in service means you used it. And because you can buy something and not put it in service in your business, you can do that in a second year. So you can only get bonus in the year it's actually being used in your business. But it started off at 100%, and then it was slowly phasing down over a couple of years. Well, at the beginning of this year, the rate for bonus was, instead of 100%, it was 40%. So those items that were able to be bucketed into like desks, lighting, pools,
carpets the least amount of time too.
I'm sorry.
Carpets probably the least amount of time.
Carpets, yeah, exactly.
Yeah, that's every couple of years.
Yeah. So, but instead of getting the full value in the first year you buy those things, they said, oh, you can only deduct 40% this year, and then the rest of the years you'll just get straight line. So meaning whatever the 60% that's left over, we're just going to divide over the remaining 4 years. Well, with our big, beautiful bill that came out on 4th of July, Freedom Day, the rules stated that it went back to 100% bonus, which is fantastic. I'm going to give you a numerical example in a second. And it said for all property that was placed in service on January 19th and beyond, 20th, excuse me, inauguration day. Did I skip a day?
No,
sorry.
you did right.
Okay.
Can I preempt this by saying, when we win, you win. You got to take the wins when you get it. We bought a property that was, we invested in a property that was put under contract February 6th of this year. So literally 2-3 weeks after that,
Congratulations. I said there was going to be a lot of contracts that got amended or changed or ripped up when that law came out.
Good point.
Because the rule says that it has to be placed in service after that date. However, if there were contracts and stuff, and I'm sure there were some shenanigans with that date. I'm just going to be honest with that. I'm not doing that, but
yeah, I'm sure there's some people out there that were looking for unlawful tax advantages.
Yeah, I mean, I live in Florida, which is the capital of fraud, so nothing surprises me anymore. So, but anyway, so law changed this year, so hugely beneficial for real estate. And I'll give you a numerical example. So let's say you buy a property and say it was $10 million and you did the cost seg and they figured out, oh, you've got $2 million worth of assets, so personal property improvements that are bonus eligible, okay?
Mm-hmm.
Well, at the beginning of the year, you would have only gotten 40% of that to deduct this year, which would have been $80,000, and at the highest effective tax rate, that's a benefit of $296,000, okay? So almost $300,000. Well, when the law changed, and we're back at 100%, you get to deduct the full $2 million the first year. So it's like, and then at the effective tax rate of that, we're looking at almost $800,000 of bonus depreciation. So just on that law change, that's $500,000 back in your pocket in year one.
So let's talk about, that's amazing. Now let's talk about someone that invested it. Let's say someone now there's, and also it's only, I got to calm down. I'm getting excited about this. So it all depends on your tax situation.
Mm-hmm.
So I'm a real estate investor versus an average person.
Mm-hmm.
Can the real estate investor, say a real estate investor puts in $100,000 and an average person with a W-2 puts in $100,000, what would be the advantages and disadvantages to both of them?
Okay. So when you say a real estate investor, I'm assuming you mean someone who's considered a real estate professional. Is that what you mean?
Correct.
Okay.
Yes.
So for all of you listening, watching, someone who's a real estate professional is considered in the code as operating a real estate business, which entitles you to different benefits. And there's basically a time and effort test, 750 hours and material participation, and we can go into that. And honestly, it's a documentation and compliance exercise. I help guide people to get there. So if you're a real estate professional, there's no limit on those losses. So real estate normally is considered activity a little bit passive losses. So if, let's say I had just had this one apartment and I have depreciation on there and the income is low, but I had a lot of depreciation the first year. If it's a hobby, I'm just doing it on the side. Well, the government says, okay, well, that's kind of passive losses, unless you have other passive income from a similar type of activity or dividends or interest, those losses get suspended until you have enough passive income to offset that, unless you fall under some other rules, which I'm not going to go into right now.
Right. General,
right. Now, if you're a real estate professional and you qualify, there's no limit on those losses. And you can be a real estate professional and still have a W-2 job.
Right.
I help people figure that out all the time. Again, it's documentation and compliance. So what happens when that works? Wait, let me finish that. So imagine, whatever, they took out $20,000 in taxes on your pay stubs. W-2. Thank you. I was getting there. And you go to file your taxes. Well, you have all this bonus depreciation coming in from this property. Well, guess what? All those losses then, if you're a real estate professional, will offset the majority of your income, and that $20,000 will be back in your pocket. So one of the things I also tell people once they qualify as a real estate professional, if they still have a job, and we know in a given year there's going to be a huge amount of bonus, I tell them basically max out their exemption so they have little to no withholding coming out of their check every time they get paid, because otherwise you're just giving the government an interest-free loan of your money. over the
Yep.
course of the year until you file your return. If I can get everybody to net zero when they file their return, nobody wants a refund. This is what I try and get people to get past. You don't want a refund. You want your money now. You don't want a year from now with no interest. So.
Now, what's the differential between a real estate professional investing 100,000 and a W-2? Now, and this is one thing I try and teach people. Some people are married and their wife doesn't work outside the house. And if they were to be considered a real estate professional and they make $500,000 a year and their wife's a real estate professional and they file joint, what happens there?
That they're both considered, the whole return is considered filed under real estate professional status. So wife or husband, anyone, as long as you're filing jointly, then you can qualify. So you can also pool activity. So for example, if my husband had, spent a little time on one property and spent other time researching activities and a little time on another property or some K1 stuff, well, you can add up all those activities to make your 750 hours, and it's just a disclosure in your return. So you're grouping them together. You don't have to spend 750 hours on one specific property.
Right. And then you get the huge tax advantages.
Yes, we actually, with some of our groups here, we do have a lot of husband and wife teams. And we see one or the other getting their real estate license for that. We actually see a lot of our folks in the military do that as a great transition plan out of the military as they start getting some flexibility. And a lot of times the non-duty spouse, because they've had to move so much, might have had to make different career sacrifices or might have a little more flexibility in what they do. So it becomes easier for them to qualify or at least get a license and start those activities. So it's one of the things that we see a lot with transitioning military couples.
I'm in this one group, Red Leaf, and I'm telling you, they have just thousands of military, and the military guys are killing it. They're absolutely killing it.
God bless. They keep the boogeymen away from us. I hope they make all the money in the world because we certainly don't take care of them after they get out.
I agree with that sentiment exactly. And this is a great transition into, ask me the question, why is real estate such a great investment?
You want me to ask you why?
I want you to ask me that.
Michael, why is real estate such a great investment?
Because it's protected by the U.S. military. The greatest force on the planet.
That is true.
The brave men of our military is by far and away the best military in the world. By far and away, there's no close second. There is no close second.
I mean, we keep the whole planet safe. I can go on a whole other tangent.
There you go. And they protect your assets. Yeah. What else could you ask for? So I don't mind paying taxes because I want to pay those guys for what they do. I mind paying unfair taxes. Yeah. And that's what I love about real estate.
Yeah. And I love that too. And unfortunately, I wish if we had fiscal responsibility as in a government, maybe it would actually go to them, but unfortunately it doesn't. And it certainly is not going to post-service care. I do a lot of volunteer work with veterans that are coming out of service with PTSD and other post-service challenges. And it's,
I agree with you that more funds should be put to that than I don't know why a senator is making $100,000 a year, but they end up having $20 million in real estate. Yeah. What is one of the biggest red flags in real estate investors and tax returns? Ooh.
Sorry, the dog.
I should have gave you these questions beforehand because they're tight.
No. The dog barked, so hopefully you can edit that out. So honestly, here are things like when you're talking about tons of deductions on Schedule C, like no income, things like that, things that you can't document. Mm-hmm. Self-employed individuals that don't have a separate entity. It's
Oh, that's horrible.
It's horrible tax planning because you lose a lot of benefits, and two, it's begging to get audited. Because people are like, well, if this is a real business, why isn't it being run like a business in a separate entity? So unfortunately, it's easier to audit an esthetician than a hedge fund guy. It's also
Okay.
it's also the IRS understands that business a little bit better than that. I would say that. I mean, I've had IRS meetings, I've been out there, and half the time I'm like, they don't even understand what my clients do, but they'll go after a school teacher. So I just tell everybody it's documentation. Like, don't be afraid of anything. Just write it down. Even if you get audited, if you got some sort of documentation, you're in the clear. I had a hard drive crash. And I lost information, and that was the year I got audited. And I just basically said, I'm missing that documentation. And they just nicely, I said, a hard drive broke, and they just made an adjustment for that part. And that was it. And we kept it moving. It wasn't contentious or anything. So I think not having your business set up in a separate legal entity raises flags. It raises flags because people are like, this is a hobby, so you don't get to deduct all that stuff. Claiming your dog and doing all these other egregious things. Like, I love my pets. You can probably hear one right now, but they don't have social security numbers. That will flag things. What looks like numerical anomalies. So right now the service is trying to modernize. They're actually very, very short staffed. They're working on, even before the shutdown, about a third of the staff that they had previously. Just attrition and a lot of things going on. So they're relying a little bit more on technology. So they're looking at numerical anomalies. So let's say you make $40,000, but then you have a $75,000 charitable deduction.
Yeah, there you go.
What happened there? But it's possible.
Right. They want to call you and ask that question.
Yeah, it's possible. Maybe you had a relative that passed away and they left you something like a car or artwork or whatever.
Bank account.
Anything. Well, you're not necessarily you might donate the cash. That's fine. If you're making $40,000 a year, you donate $60,000 cash. Somebody needs to smack you in the head a little bit. Sorry, that's old. You need the wooden spoon. Is my.
That's an Italian.
Yeah, sorry.
I guarantee it.
We were joking
about
spoon. Italian Americans before. I said you need the wooden spoon. That somebody needs to knock some sense into you. But metaphorically, but those are things that will flag getting audited. I definitely think that the likelihood is lower than people think, and I'll just leave it at that.
I agree with that statement wholeheartedly. I said it this way. I've been in business for 30, 40 years, and I've never been audited. It's because I did the right thing. If you do the right thing, odds are they're going to stay away from you.
Yeah. And when going to law school, everyone thinks that in order to deduct something or to take a position, like regular taxpayers think, oh, this has to perfectly line up with everything and it's got to be spelled out in black and white in some instruction. Right. Well, high net worth taxpayers and professionals and investors know that there's gray area, and that's what they hire lawyers like me for. And guess what? To sign a tax return, I just need to have 30% confidence that something would fly. So meaning that there's some case law or something out there. So it's okay to be aggressive. It's not okay to be negligent and have no position for something, but it doesn't have to be perfect. You have to find some law and some support for it, but it's not always going to be 100% right line rule. You can operate in the gray.
Right. Yeah. And most of the time, I mean, I've been very blessed to stay out of court pretty much my entire life. If you, how do I put this? If you do something wrong, but you do 90% right, you do something wrong, then, when you're in negotiations with the IRS, they'll either say, pay the taxes on it, pay the taxes and the penalty, and that's about it, right?
Yeah, and I would almost say instead of looking at it as do something wrong, because there's like guilt that's attached to that. Sorry, I'm a word nerd.
I appreciate it. I appreciate that.
Errors or omissions. Okay.
Errors, omissions. There you go.
Errors
That's a
and
better way of putting it.
omissions. I made a boo-boo.
Right.
Okay. Or I forgot to include something. That's generally what you're going to see. But a lot of times, certainly in my larger clients in my career, if you were getting examined, we'd find something else. Oh, you know what? I forgot about this other thing that I should have deducted. So sometimes you can bring different things to the table, like a negotiation. And they just want to see that the file's wrapped up and they did something and you did something and it was fair. And that's it. They're not, again, we're not talking about fraud. We're talking about errors and omissions, being normal, solid citizens doing the right thing, and that's it.
Right. I appreciate that. Hey, Jessica, I've taken up way too much of your time. Thank you so much for being on. Now, if somebody would like to hire you or work with you, how would they do that? How would they get in touch with you? Where would they go?
Sure. Easiest way to do that is to go to my website and book a consultation and we can talk. It's archangelsolutions.co. So leave the M off. Because it was a smart fiscal decision for me not to have the M on there. And you can go there. You can find me on LinkedIn. You can find me on Facebook and Instagram. But I think the easiest way is just go to the company website. You can find out a little bit about me, what we do, and just click book a consultation and we'll take it from there.
Awesome. Jessica, thank you so much for being on the podcast. We do appreciate it. And if anybody would like to get some consultation, I would highly recommend Jessica. She's been a wealth of knowledge for the times that I've known her. Thank you very much for being on the show.
You're welcome. Thank you. One more thing, Michael. If this airs before November 18th, I'm having a free, no upsell involved, fourth quarter tax planning webinar on November 18th at 8:00. So if you go to my website, you can find out more information about that. And I really only did that because I was sick and tired of sitting through these other webinars that gave you 4 minutes of knowledge and 56 minutes of upsell.
Right.
I'm just trying to set you up for success for next year with some tips for individuals, investors, and entrepreneurs.
Thank you so much for being on the show. We really do appreciate it. And for everybody else, like and subscribe and hit that notification button. Thanks very much.
Take care.
Thanks for listening to Driven, the Unscripted Success Podcast. Want to share your story? Apply to be a guest at drivensuccesspodcast.com/guest.